In today's video, I want to examine the financial arrangement that has quietly underwritten American prosperity for the last 50 years. Most people have never even heard of it, and almost nobody in mainstream financial media is talking about what's happening to that arrangement right now. The conflict in the Middle East, more specifically, the attacks on the Gulf Coast countries and the closure of the Strait of Hormuz, is causing a massive rift to appear in this arrangement between the United States and oil-producing countries like Saudi Arabia. Most people only see this crisis in the Middle East as a geopolitical story. They see a war, a closed strait, and an oil spike. What I want to do is go underneath the surface and see what the second order effects of this war are and how they can impact corporate margins, capital flows, and the long-term demand of US assets, both treasuries and equities. Let me paint a picture for you guys. In 1971, the United States, with Richard Nixon as president, abandoned the gold standard and replaced it with the fiat system that we know and use today. Just a few years later, in 1973, the United States and Saudi Arabia made an agreement that the kingdom would price its oil in dollars. This agreement with the head of OPEC caused other nations within the organization to follow suit and also price their oil in US dollars. With major oil producers now promising to price their largest export commodity in USD, the United States agreed to provide security guarantees and a military presence in the region. What goes under a lot of people's radar is that not only were countries like Saudi Arabia agreeing to sell oil in dollars, but also to recycle those dollars back into US financial assets like treasuries and equities. The main idea to take away from this is that a system was put in place where demand for oil also created demand for dollars in US assets. This is critical because if we think of an asset such as a treasury, high demand for treasuries keeps yields low, which keeps borrowing costs on US denominated debt also low in turn. For over 50 years, this system has been one of the most powerful and least discussed aspects of American financial markets. Fast forward to 2026, and we are beginning to see the erosion of this arrangement due to the ongoing Gulf conflict. Think about it like this. If demand for oil leads to a demand for dollars, what happens when oil can no longer be exported through one of the most critical choke points in the entire world? If countries like Saudi Arabia cannot get their product out, which is the situation that they find themselves in now, then the revenue that they would have received stops as well. And if we follow this chain of events that I just went over, then little to no oil revenue means little to no dollar demand from those affected countries. Additionally, the US and Israel joint strikes in Iran led to the Iranian Revolutionary Guard Corps, or IRGC, retaliating against other Gulf countries. These countries like Saudi Arabia, Bahrain, Qatar, and the United Arab Emirates host military bases or support the United States in one way or another. And while the governments of these countries want to limit panic and would say otherwise, it is obvious that these Iranian attacks were effective in causing significant damage to infrastructure across these different countries. Why am I mentioning this? Well, not only are revenues from exports down, but now these nations have to utilize capital to rebuild the damaged domestic infrastructure. This again means less sovereign capital is able to be used to purchase US assets. If you've been following the news for a while now, you know the transition from dollar-denominated trade has actually been underway for a while now. Back in 2023, at the World Economic Forum, the Saudi finance minister, Mohammed al-Jadaan, stated that the kingdom was open to discussing trade settlements in currencies other than the US dollar. This has led to ongoing negotiations with countries like China to price some of the oil sales in yuan. It is important to realize that even with all of this occurring, the US dollar is not collapsing and likely won't be anytime soon. The vast majority of trade around the world is still settled in US dollars, and the liquidity and stability that the dollar offers is still far superior to that of other currencies. What is also important to realize is that the downfall of the dollar will not happen overnight. The petrodollar remains strong and is not yet being replaced, but its power is being undone at the margins. And if this continues over years, this margin erosion could lead to a major structural shift in the world economy. All in all, the dollar has been and is being replaced gradually. The conflict in the Middle East has just hastened that process. As I mentioned earlier, the purchase of US Treasuries by sovereign wealth funds has been consistent for around 50 years, and it's acted as a floor under Treasury prices and a cap on yields ever since. With that buying slowing down, the demand for US Treasuries changes significantly. As such, weakened US Treasury demand forces yields higher to attract investors. Combine this upward pressure from weak demand with the Fed holding a higher for longer stance, high inflation, and large-scale US deficits, and you'll understand why the 30-year Treasury yield reached above 5% for the first time since 2007. This range of higher yields across the curve means that there are higher discount rates, which can put downward pressure on equity markets as the spread between yields and asset returns gets smaller, leading to more people placing their money in safer fixed income vehicles. Let's go back to Saudi Arabia. The Ministry of Finance released their first quarter budget details for 2026, and the kingdom's budget deficit has ballooned to over 125 billion rials. That's the equivalent of around 33.5 billion US dollars, and this is in a single quarter. Their oil revenues have fallen off significantly because of the standstill in the Strait of Hormuz. Their domestic spending on infrastructure and their military has surged by over 25% just to deal with the regional conflict. And I want you guys to think about the gravity of this shift. For 50 years, Saudi Arabia operated with massive surpluses that they then dumped into US Treasuries because they didn't have anywhere else to put the cash. Today, they don't have this surplus to recycle. They're actively running a massive deficit, and when a sovereign power runs a deficit of this scale, they stop buying your debt. And in fact, if we just use our logic, the next step in this chain is to start liquidating their existing foreign reserves just to balance their books back at home. So you have the US government running multi-trillion-dollar deficits, needing to auction off massive amounts of new bonds every single week. And at this exact moment, their largest historical buyer is facing a multi-billion-dollar cash crunch. That is the bottleneck that we find ourselves in right now. The media is telling you that the 10-year and the 30-year yields are rising because of inflation. The reality is actually much simpler, in my opinion. It is a supply and demand mismatch in the global capital markets. The largest buyers in the world are broke. And like I said earlier, the US Treasury is then forced to pay a higher amount to attract other investors. And I want this to be clear. Make no mistake. This isn't just an institutional problem that's confined to Wall Street trading desks or the Washington auction rooms. Those higher Treasury yields are the baseline anchor used to price consumer risk across the entire domestic economy. When the Treasury is forced to push yields higher to attract alternative capital, it triggers an immediate repricing of every consumer credit vehicle in America. Mortgage rates creep higher. Small business commercial loans follow suit and also get pushed up. Corporate debt refinancing costs skyrocket. This means that margin compression we're seeing overseas is transferring directly into the balance sheets of American companies and households. Domestic interest rates are not purely driven by the Federal Reserve's monthly statements. Right now, they're being dictated by a localized conflict that's thousands of miles away and is starving the US debt market out of its primary sovereign funding sources. Let me tie this all together. The conflict between the United States and Iran, as well as the Hormuz closure, is not just an oil story. It is putting pressure on an already cracking financial agreement. The Gulf states are losing export revenue, having to rebuild domestic infrastructure, and are therefore having to reassess the 50-year assumption about where their capital belongs. The petrodollar world is not ending, but it is changing. It's important to be aware of in order to make the most efficient moves as an investor. That is all for today's video, guys. Thank you all for watching and supporting this new channel. Please subscribe and leave a comment below. I created this channel because I want to have more conversations, so feel free to leave your opinions and your thoughts in the comments below. And if you want to go deeper, I will be posting my first Substack essay with my thoughts on the situation tonight. You can find a link to that in the description and in my channel bio. Thank you all again, and I will see you in the next video.